Warren Buffett is worth over $140 billion. He lives in the same house he bought in 1958 for $31,000. Drives a regular car. Eats McDonald's for breakfast. And his secret to getting filthy rich? He says it's so simple a 5-year-old could understand it. So let's test that. Imagine you're a kid with $5. You could buy candy right now and it'd be gone by tomorrow. Or you could do something different. You could buy a lemonade stand. That stand makes you $1 every week. After 5 weeks, you've got your $5 back. But here's the thing. The stand keeps making money. Week 6, another $1. Week 10, another $1. A year later, you've made $52 from a $5 investment. That's what Warren Buffett does. Except instead of lemonade stands, he buys companies. And instead of $5, he's throwing around billions. But let's rewind. Because Warren wasn't born rich. He was born in Omaha, Nebraska during the Great Depression. His dad was a stockbroker who lost everything when the market crashed. So young Warren grew up watching his father rebuild from zero. And somewhere in that chaos, a lesson stuck. Money isn't about being flashy. It's about being smart. At 6 years old, Warren bought 6 packs of Coca-Cola for 25 cents each. Then he sold each bottle individually for a nickel. Do the math. He paid a quarter for 6 bottles and sold them for 30 cents total. 5 cents profit per pack. Not life-changing money, but he'd figured something out. Buy low, sell high. Find the gap, exploit it. Repeat. By age 11, he bought his first stock. 3 shares of City Service for about $38 each. The price dropped immediately. Warren panicked, but his dad told him to wait. Eventually, it climbed back up to 40 and Warren sold. Felt like a win until the stock shot up to 200 shortly after. That gut punch taught him a lesson he'd never forget. Don't sell just because you're nervous. If the company's solid, hold on. He started reading everything he could about investing. At 13, he filed his first tax return and deducted his bike as a business expense because he used it for his paper route. At 14, he bought 40 acres of farmland with money he'd saved. Rented it out. Made profit. The kid was already thinking like a tycoon while his classmates were thinking about prom. Then he found a book that changed everything. The Intelligent Investor by Benjamin Graham. If Warren's childhood was the trailer, this book was the feature film. Graham's philosophy was brutally simple. Don't buy stocks because they're popular. Buy them because they're worth more than what you're paying. Sounds obvious, right? But most people don't do it. They chase hype. They buy high and panic sell low. Graham said do the opposite. Find companies trading for less than their actual value. Buy them. Wait. Let the market catch up. Warren devoured that book like it was the cheat code to life. He went to Columbia just to study under Graham. Worked for him after graduation. Absorbed every principle. And when he finally went out on his own, he took that strategy and ran with it. 1956. Warren starts his own investment partnership with $100 from 7 family members and friends. He's 26. No office. No fancy team. Just him, a calculator, and an obsession with finding undervalued companies. He promised his investors 6% returns annually and said he'd take a cut of anything above that. Seemed fair. What he didn't tell them was that he was about to average 30% returns year after year. Here's how he did it. While everyone else was chasing hot stocks and gambling on trends, Warren was reading. Like actually reading. Annual reports. Balance sheets. Footnotes. The boring stuff nobody wanted to touch. He'd find companies that were profitable, well-managed, and trading for peanuts because Wall Street didn't care about them yet. Then he'd buy massive chunks. Sit back, wait for everyone else to realize what he already knew. Take American Express. 1963. The company got hit with a scandal involving a salad oil scheme. Don't ask. The stock tanked. Everyone panicked and sold. But Warren did something weird. He went to restaurants and watched people pay with American Express cards. Went to banks and saw them still processing Amex transactions. The scandal was bad, sure. But the business itself was fine. Customers still trusted it. So Warren bought in heavy while it was cheap. A few years later, the stock tripled. He made millions. That's the Buffett pattern. Ignore the noise. Focus on the fundamentals. Does the company make money? Do people need what it sells? Is management competent? If yes, buy it when everyone else is running away scared. But Warren wasn't just good at picking stocks. He was insanely disciplined. He didn't buy things because they were exciting. He bought them because the math worked. And if the math didn't work, he'd sit on cash and wait. Sometimes for years. While other investors felt pressure to always be doing something, Warren was comfortable doing nothing until the right opportunity showed up. By 1962, he started buying shares in a struggling textile company called Berkshire Hathaway. It was cheap. Too cheap. He figured he'd make a quick profit. But the company kept disappointing him. The manager offered to buy back shares at a certain price, then lowballed Warren at the last second. Warren got mad. Really mad. So instead of selling, he bought enough shares to take control of the entire company. Just to fire the guy who tried to cheat him. Pettiness aside, Warren now owned a dying textile business. Not exactly genius-level investing. But here's where it gets interesting. Instead of trying to save the textiles, he used Berkshire as a shell, a vehicle to buy other companies. Better companies. Profitable ones. Insurance firms. Candy makers. Newspapers. He turned a failing textile mill into a holding company for his growing empire. And that's when the real compounding started. By the 1970s, Warren wasn't just running an investment fund anymore. He was building something that would become the most successful holding company in American history. And the strategy was deceptively simple. Buy great businesses, pay fair prices, and never sell. Most investors treated stocks like trading cards. Buy low, sell high, move on to the next thing. Warren did the opposite. He bought businesses he wanted to own forever. See's Candies, 1972. A small California chocolate company with loyal customers and fat profit margins. Warren paid $25 million. Wall Street thought he overpaid. But Warren saw something else. A company that could raise prices every year without losing customers. Because when you're buying chocolate for Valentine's Day, you don't cheap out. That little candy company has generated over $2 billion in profit since he bought it. And he still owns it. Then came the insurance companies. GEICO, National Indemnity, a bunch of others. Insurance became Warren's secret weapon. Here's why. Insurance companies collect premiums up front, then pay claims later. Sometimes years later. That gap creates something magical. Float. Billions of dollars sitting around that technically belongs to policyholders, but hasn't been claimed yet. Warren could invest that float in stocks and businesses while waiting to pay it out. Free money to compound. It was like playing poker with someone else's chips. If you win, you keep the profits. If you lose, well, you still have to pay the claims. But the upside was enormous. The genius wasn't just what Warren bought. It was what he didn't buy. During the dot-com boom of the late 1990s, everyone lost their minds over internet stocks. Companies with no profits, no revenue, just a website and a dream, were going public and tripling overnight. Pets.com, Webvan, eToys. Investors were throwing money at anything with a .com in the name. Warren sat it out. Completely. People called him washed up, out of touch. A dinosaur who didn't understand the new economy. One magazine ran a headline asking if Warren had lost his edge. His response? I don't invest in things I don't understand. and I don't understand how a company losing money is worth billions. Then March 2000 hit. The bubble popped. Trillions evaporated. Pets.com went bankrupt. Webvan collapsed. Investors who mocked Warren were now broke. Meanwhile, Berkshire's stock barely flinched, because Warren owned boring, profitable businesses that people actually needed. Insurance, utilities, railroads, candy, furniture. The stuff that doesn't make headlines but prints cash year after year. That's the real secret. Warren didn't get rich from one brilliant trade. He got rich from decades of compounding returns on boring businesses that most people ignored. He famously said his favorite holding period is forever, because selling means paying taxes, paying fees, and trying to find something better. Why do all that when you already own great companies? By the early 2000s, Warren was a living legend. Berkshire's annual shareholder meetings became pilgrimages. Thousands of investors flew to Omaha just to hear him talk for 6 hours about insurance float and capital allocation. He'd sit on stage with his business partner Charlie Munger, drink cherry Coke, eat See's candies, and answer questions. No PowerPoint, no corporate jargon. Just two old guys talking about business like they were sitting on a porch. The results spoke louder than any presentation. If you invested $10,000 in Berkshire in 1965, it would be worth over $300 million today. Not a typo. $300 million. The S&P 500 over the same period would have turned that $10,000 into maybe $2 million. Still great, but not even close to Berkshire's returns. Warren didn't just beat the market. He obliterated it for 6 decades straight. But here's what makes Warren different from every other billionaire. He still lives in the same house he bought in 1958 for $31,500. Drives himself around. No private chef. No yacht. He eats McDonald's for breakfast most mornings and drinks 5 Cokes a day. The guy's worth over $100 billion, and his idea of luxury is a Dairy Queen blizzard. He pledged to give away 99% of his wealth. Already donated tens of billions to charity, mostly through the Gates Foundation, because he figured Bill and Melinda were better at spending it on helpful things than he was. And he's still working, still reading annual reports, still taking calls from CEOs, still showing up to the office every day at 90-something years old. Not because he needs the money, because he genuinely loves the game, loves finding great businesses, loves watching them compound, loves teaching people how capitalism works when you do it right. Warren proved something most people don't believe. Getting rich isn't about being the smartest person in the room. It's about being patient, disciplined, and reasonable. Buying quality, avoiding stupidity, letting time do the heavy lifting. The formula isn't complicated. Live below your means. Invest the difference. Don't panic when markets crash. Don't get greedy when they boom. Repeat for 60 years. So yeah, the kid from Omaha who sold gum door to door became one of the richest humans ever. Not from luck, not from inheritance, from reading, thinking, and refusing to follow the crowd off every cliff they ran toward. And the wildest part? He's still going, still compounding, still teaching anyone willing to listen that wealth isn't built overnight. It's built one boring, profitable, well-managed business at a time. That's the lesson. You don't need to be a genius. You don't need insider tips or a finance degree. You just need to understand value, ignore the noise, and let time work for you. Warren's entire philosophy fits on a napkin. Buy good things cheap. Don't sell them. Wait. The hard part isn't understanding it. It's actually doing it while everyone around you is panicking or chasing the next shiny object. Warren figured that out at 6 years old with Coca-Cola bottles. The rest was just repetition at a bigger scale. And now you know exactly how he did it.